Hey everybody, held for sale then. Okay, held for sale. As its name suggests, it's when you have some PPE which we normally use, but now we're not going to use it anymore. Now we're going to sell it. That's our primary aim. And remember, we only depreciate things because they're being used. Now we're going to sell it rather than use it. There's no depreciation. So that's the first thing with held for sale items. There's no depreciation. But as it's no longer going to be used, it's going to be sold. It drops into current assets, held for sale. Okay, no longer in long-term assets because it's got to be sold within a year, or hopefully it will be. Okay, now think about this. What value should we put it at? Would it be fair value, or would it be fair value less cost to sell? Well, think about it. It's held for sale, so the value to us is fair value less the costs of selling it. And if I was to tell you the costs of the fair value less cost to sell is 90, we would therefore bring it in at 90, and the difference of 10 would pop over there to the income statement. Okay, so far so good. Now let's have a look at that again. PPE in 100. Now we decide to sell it. As soon as we decide to sell it, then we have to bring it into held for sale in current assets. And the fair value minus cost to sell this time is 110. Okay. Now remember, we need to be prudent, and prudence means if we're going to show a loss, show the loss immediately, like we did there. But if we're going to show a profit, wait until that profit's actually been made. Now this item hasn't actually been sold yet, and so we would keep this at 100. Okay, so what you do, rule number 1 is actually then take to current assets, held for sale, and I guess rule number 2, at what value? At the lower of the current carrying value and the fair value less cost to sell. And that's just, that's just common sense. It's only prudence, really. It's the practice of prudence. So we would bring it in there at 100. Now, if it's still around at the year end, so the fair value minus cost to sell at the year end, if that's now 90 at the year end, then you would take 10 off and bring it in, and that would go to the income statement. But I'm just going to complicate that a bit more than now. Let's say the PPE was 100. We decide to sell it, so it goes into held for sale in current assets, and its fair value minus cost to sell at that date is 90. So therefore we would bring it in at 90, show the loss immediately, that would go to the income statement. And then by the year end, the fair value minus cost to sell is now 95. Okay, we take it up to 95 and we put 5 back into the income statement, and 95 would be our current assets. Okay. Have a look at this though. If I do this over here, now let's say the PPE was 100. Yeah, we wrote off 10 and we put it to the income statement because the fair value less cost to sell was 90. However, the year end this time, fair value minus cost to sell, is not 90, it's 105. Now we can only take it not up to 105, but up to 100. So you put 10 to the income statement. Okay, can you see why? You can only take it back as much as a previous impairment at the year end. Okay, so let's just do one more and make sure we understand this. PPE then, let's say it's 200. Decide to sell it, so it goes into held for sale. At that date, its fair value minus cost to sell is 180. So I bring it in at 180. That goes off to the income statement. The year end fair value minus cost to sell is 210. What can I do? Well, I can only reverse it as much as the previous impairment, so I could only take it to 200. Alright, hope that makes sense. So let's try and bring that all together then. So first of all, there are criteria for held for sale. And have a look in the textbook notes, but the things like a probable sale in less than 12 months, actively looking for a buyer, reasonable price. Basically, it's making sure that this actually is trying to be sold. Then what you do, you put it to current assets held for sale, and you do prudence, so it's the lower of carrying value and fair value minus cost to sell. No depreciation from then on. And then at the year end, we revalue to the fair value minus cost to sell. But if that's upwards, only as far as a previous impairment. Okay, have a go at the examples, and that's that.